A sudden medical diagnosis, a major accident, an unexpected job loss. Financial shocks rarely give you a warning. They hit your life like a hammer. When that impact happens, your monthly bills don't stop. And without cash on hand, most people fall straight into a trap. They take out high-interest personal loans, or they're forced into liquidating their long-term investments at a massive loss just to keep the lights on. You can avoid that entirely. In this video, we are going to build a step-by-step blueprint for a 6-month emergency runway, a secure reserve of cash that you can access within 24 hours whenever things go wrong. The first thing you need to understand is the core philosophy of this money. An emergency fund is a defensive insurance policy. It is not an investment vehicle meant to generate wealth. Its only job is to protect you. To figure out exactly how much protection you need, grab a pen and paper or open a notes app on your phone. We are going to calculate your specific survival number right now. Financial survival depends entirely on pre-calculated preparedness. Once you have a strict system in place, you shift your response to a crisis from sudden panic to following a methodical process. Step 1 is separating your true survival costs from your lifestyle habits. We need to find your absolute bare minimum monthly burn rate. Let's look at this digital ledger. We start with a baseline income of 25,000 rupees. Under expenses, list unavoidable needs. Rent is 8,000 rupees. Utilities are 4,000 rupees. An EMI takes 2,500 rupees. Subtotal 14,500 rupees. Next, add up the wants. This includes dining out and discretionary shopping, adding another 5,000 rupees. Cross these wants off entirely. In a crisis, lifestyle spending halts. You don't need takeout if you lose your job. Take that lean survival number, 14,500 rupees, and multiply by 6. 6 months is the safety benchmark to recover. The math gives us a final target of 87,000 rupees. Run this calculation and write your number down. Isolating your strict needs ensures your emergency target doesn't become artificially inflated. If you try to save 6 months of your full lifestyle expenses, the number becomes so intimidating that you might actually never start. Knowing your number is one thing, actually reaching it is another. The primary reason people fail is that they leave emergency cash in their checking account, where it blends with daily spending. To fix this, mandate the creation of a completely separate, dedicated bank account. It should be entirely out of sight from your daily financial activities. Do not carry the debit card. Next, temporarily pause all of your long-term investments. Stop mutual fund SIPs and halt individual stock purchases. Take those paused funds, along with any sudden lump sums, like a bonus or a matured policy, and aggressively divert every single rupee into that new isolated emergency account. Prioritizing immediate liquidity over long-term market gains accelerates the timeline for your financial shield. Every 1,000 rupees you move reduces debt reliance and prevents selling investments when the market is down. Once you hit your target number, you face a dilemma. If kept in pure cash, inflation eats its power. But locked in tight investments, it's useless when needed. To balance liquidity and stability, we use the 10-20-70 allocation framework. The first tier is 10%. Keep this in physical cash at home for localized emergencies where digital payment networks fail. The second tier is 20%. Keep this in a separate savings account. This gives you 24/7 access to cash via an ATM. Do not put this portion into a fixed deposit. FDs often carry early withdrawal penalties, which destroys the utility of having emergency cash in the first place. You need it fast, and you need it free of fees. The final tier is the remaining 70%. Deploy this capital into liquid mutual funds. As seen on this tracking interface, liquid mutual funds yield 5 to 7%, helping offset inflation. Crucially, they carry zero exit loads, processing withdrawals straight to your bank account within 24 business hours. To bridge the gap during that 24-hour waiting period, use a credit card to absorb the shock on day 1. Once you calculate your exact 6-month target based only on strict needs. You establish an isolated saving system to rapidly fund it, and you apply the 10-20-70 distribution rule to protect it. When you have this structure in place, the terror of a sudden medical bill or unexpected unemployment dissolves. Panic is replaced by a manageable, predictable 6-month runway. Don't wait for a crisis to start. Open that secondary bank account today, run your math, and drop your calculated 6-month target number in the comments below. Long-term wealth is built on a foundation of stability. Without a defensive baseline, a single emergency can force you to liquidate your portfolio and wipe out years of investment progress.